All right. So we left off talking about the next step, which would be taking the standard deduction or the itemized. Well, to figure that out, we have to figure out which one is greater. Do we want to take the standard or the itemized? Which one is greater? We already know what the standard deduction is over here. For single, it's 12,000 for 200. For married, it's 24,400. We already know that. Now we just have to figure out what our itemized deduction is. And so for that, we have to go to Schedule A. So let's scroll down or flip over to Schedule A. There we go. Schedule A. We know it's Schedule A is the right one because it says itemized deductions up at the top, right? So we've got to start filling this out to calculate which path we should take. This first section, I get a name up here, right? So you put the name and social. Okay, but for this first section, medical and dental expenses, we're not going to bother. That will complicate things more than we want to right now. So we're not going to bother with that. We're going to start up here with the taxes you pay. This is our state and local taxes. Okay, so one of the things, state 5A, we get to deduct state and local income taxes or general sales tax. All right, they threw in that or general sales tax because members of Congress from states like Texas, which we have no state income tax, were like, hold up, you're gonna let Californians and New Yorkers deduct their federal or their state income taxes, but states like Texas and Florida don't get anything? No. We're going to get something. And so they gave us general sales tax, right? You may include either income taxes or general sales tax, but not both. Well, that's because people in New York and California, yeah, they pay state income tax, but they also pay sales tax. And so they don't want, it's an either or situation. Well, here in Texas, our state sales tax is, our state income tax is 0. So we're always going to take our general sales tax, which brings us to the next sentence. If you elect to include general sales taxes instead of income, check this box. So we are always going to check that box. Okay. So 5A, we've got to calculate out our general sales tax. There are two ways of doing this. One, if you were really, really on top of it, and I don't think anybody ever is, you could take your receipts from January 1st, 2019, all the way to December 31st, 2019, and calculate up all of the amounts that you paid in sales tax. That's too much. Like, even the IRS says, look, that's crazy talk. No one's going to do that. So what they do is they give us a table of estimation, and they say, look, okay, you could calculate it out all by your receipts. If you do that, you have to provide us with proof. Don't make our lives harder. Don't make your lives harder. We'll just give you an estimation. And so you plug in your income, and they say, okay, you live in this state, sales tax is this percentage, your income is this. We are going to estimate that you paid X amount in sales tax. That's the way they go about doing it. For our purposes, I'm not going to have y'all look up that table. What I'm going to do is I'm going to give you in the facts the amount of money that these individuals spend on taxable goods that are subject to sales tax. And so let's just say they spend $60,000 on taxable goods. Okay, so I've given you that information. They've spent $60,000 on taxable goods. The sales tax rate in Texas is 8.25%. So we need to figure out how much approximately did they spend on sales tax. Well, if they spent $60,000, then 8.25% of that $60,000 is going to give us our answer. So take 8.25% of $60,000. That gives us $4,950, right? So that's what we would put here in 5A, 4,950. Okay. And the next item up is 5B, state and local real estate. So real estate right here, that's just another word for property, like physical property, not like land, homes. Okay, that's real estate. Down here, 5C says state and local personal property. Well, those are things like cars, jet skis, and really we're not, things that are movable, tangible and movable. We're not going to have any personal property taxes, so that's going to be a 0, right? So real estate taxes, let's say this is going to be in the fact pattern. I'm going to make it, let's say they paid $6,000 in property taxes. Okay, this past year, this person paid $6,000. Okay, so line 5D says add lines 5A through 5C. So let's add them up. That gets us to $10,950. Now we're given a choice. We're not given a choice. We have to make a decision. It's not even a decision. We have to follow instructions. Enter the smaller of line 5D or $10,000. Well, what's smaller? 5D, 10,950, or 10,000? Well, obviously $10,000 is smaller, so we put $10,000 here. That means we're limited to how much we can deduct from our state and local. So we're limited to $10,000. So we lose out on deducting $950 in this scenario. Okay, we lose that $950. Okay. Other type of taxes, we don't have any, so that's going to be 0. Okay, and then 7, add lines 5E through 6. So 5E and 6, well, 10,000 plus 0 is $10,000. Okay, let me go ahead and erase that. Okay, let's move on. Here is the home mortgage interest. Well, yeah, we get to deduct something for home mortgage too, right? 8 says home mortgage interest and points. Don't worry about the points. We're just going to focus on the interest. And we're not going to check this box. This box is not checked, okay? So 5A, home mortgage interest and points reported to you on Form 1098. We know that form. So let's say it was, I think I used $9,000 yesterday. Okay, so $9,000. Okay, in interest. Mortgage interest, well, we don't need to worry about that. So that's going to be a 0.0. 8D, 0. Don't worry about that. Now we add, so we don't have to worry about that. Okay. Now we add lines 8A through 8D. Well, that's pretty simple. It's just going to be $9,000. Investment interest, we don't have any, so 0. Okay, and then add lines 8E and 9. Again, fairly simple, $9,000. Okay, next up is gifts to charity. This is what most people think about when they think about deducting for their taxes, gifts to charity. So, rule of thumb, you need any gift to charity must be made, any gift that you can deduct must be made to a non-political, non-profit. Non-political, non-profit. Okay. The key word that you want to look for in the fact pattern is something called a 501c3 organization. That's a non-political, non-profit. Technically, groups like the Republican Party and the Democratic Party, those are non-profits because no one's in it to make none of that leadership makes a profit. Everything gets funneled back into the organization. But it is political, right? So you can't you can't deduct those contributions. You make a contribution to a political candidate, you cannot deduct that. Okay, only non-political, non-profits are deductible. Okay, I'm going to give you a list of things in the fact pattern of where people have made contributions. Some of them are going to be 501c3s right here. Some of them are going to be political organizations. It's going to be your job to identify what is what, and it's going to be fairly clear, right? I'm not going to try to trip y'all up or anything. It's going to be things like the re-election campaign. Well, see that? It's political. Okay, can't count those. So you'll have to decide what to count, what not to count. Okay, so we get here, line 11, gifts made by cash or check. We are not going to worry about this next line. If you made any gift of $250 or more, see instructions. That's just to prove that you've made that gift. We're not going to worry about that, okay? So let's say they've made $3,000 in gifts over the year, okay? We're not going to have them make any other gift. So line 12 says, other than by cash or check. No, we're not going to worry about that. Okay. Carryover, no, we're not going to worry about that. So those are going to be 0, right? Line 14, add lines 11 through 13. So we add them, and they're $3,000 there. Okay. Line 15 cap, we're not going to worry about that. We're not going to worry about line 16. Now here we are, line 17, and this is what we will worry about. Add the amounts in the far right column from lines 4 through 16. So we go back up. Line 4, we don't have anything, right? So 10,000 plus 9,000 plus 3,000. That's going to give us $22,000 for itemized deductions. Okay, so just looking at it now, which way should this person go? Should they take the standard deduction? Let's assume that they're single. Okay, should they take the standard deduction of $12,200, or should they take the itemized deduction of $22,000? Well, obviously they should take the itemized because it's more. It is more, right? Now, let's say they were married. Let's assume they were married. Well, now the standard deduction is $24,400, and the itemized is only $22,000. The logical thing for them to do is to take the standard rather than the itemized. But let's say for some reason they say, no, we only want to deduct what we have given away. So even though the itemized is lower, we're going to take this, right? If you did that, right? If this was a married and you put 22,000 when they should have taken 24, it will be wrong unless, and this is a big unless you check this box 18. If you elect to itemize deductions, even though they are less than your standard, check this box. So if you come in and check that, then it would be right. But if you don't, it will be wrong. Okay, so we have $22,000. Where do we take that? We take that back up to the 1040 standard or itemized, and we put $22,000 here. Okay. Line 11A, add lines 9 and 10. Well, 10 is 0, so we go $22,000 again. And then it's taxable income. Subtract line 11A from line 8B. Line 11A from line 8B. So 85,400 minus 22,000, and that's going to give us $63,400, and that's going to be our taxable income. Okay, so we'll stop there real quick, and then we'll get to calculating taxes, which y'all already did yesterday.